Louise Bedford here, your host of the Talking Trading podcast. This is how traders excel. This week, for our final show for 2024, I'm joined by Mr. Christopher Tate, my business partner. How are you, Chris?
Hi, Louise.
I'm so excited about today's show. Chris is going to discuss the key learning points from 2024, and I'm going to do a market wrap on what's been happening in the Australian market and how it's compared to overseas markets. So this is the show to listen to. What you're going to get out of this is the things that you could have done differently in 2024, which is going to set you up for success in 2025. So, Chris, are you ready to knock it out of the park?
That might be overselling it, but we'll give it a go.
So, Chris, I'm very excited to hear what you have to share with us today. Tell us a little bit about what you're going to talk about, and then we can also advise people to go to YouTube to watch the video of this, because then you'll be able to see the full picture. We will be sharing slides today. So our youtube.com.au/trading game channel is the one to go for.
What I thought I would do is take specific examples of things that interested me, things where there were potential to make money, because after all, that's what we're actually here for. And so I'm going to take various learning points from each market that I sort of follow and point out some bits and pieces that are of interest to me. So I'm going to look at US markets, our local market, two commodities. I will mention Bitcoin in passing. And then there's a little bit of a Christmas present, because next year is bringing something very interesting. So in terms of markets, this is a little league table of world markets, generally positive. Only two negative markets for the year to date as we're recording this, and that's France and the Hang Seng in Hong Kong. Again, the standout markets in terms of the major markets are, of course, the US markets, particularly the NASDAQ. Again, S&P 500 has been performing very well. And more interestingly, the Russell 2000, which for some time had languished. You can see us down here at 11.29%, and I'll speak about our market in a little bit. This might look impressive. This is impressive. These are obscure markets. I don't expect anybody to know what these are. The Merval is Argentina, Caracas, Venezuela, if you know your geography. CSE is Colombo, which is Sri Lanka. Lusaka is in Zambia. And Bucks, I actually had to look this one up, is Budapest. This highlights a point that's going to be a little bit of a theme as I go through this. Just because a market generates a return that looks impressive, or an instrument generates a return that looks impressive, doesn't actually mean that you can trade it. You have to have this unique combination of a market that trends, but also produces a return. So, for example, you could try and trade Argentina, but my response to that would be good luck with your projects. So there is this balancing act that we're caught in. And this also applies to any instrument we buy, like a share or a commodity. And we'll see a few of these as we go along. People might thought that I would begin talking about the re-election of the Ginger Gibbon. And yes, in an ideal world, the vilest man in the world and the President of the United States will be two different people, but they're not. The reason I'm not going to talk about the election is quite simple. Markets don't care. They really don't care who is in power. Unless there is something catastrophic that occurs, it makes no difference to the market at all. This is a little snip that I picked from dozens that are on the internet, which looks at the performance of markets through various administrations. And you can see there's not a lot to pick from. So the market in and of itself doesn't care. Yes, we've had a little bit of a bump, but the thing to note is that bump has occurred with the S&P 500 or in a bull market. So you're not seeing any dramatic change. You're not seeing a change in tone that you should be aware of. You're just seeing a continuation of same old, same old. Speaking of the S&P and the S&P 500, At the point of recording this, I believe the S&P 500 this year had made 54 new highs, and it made another one last night. What I've done on this chart here is I've simply indicated the new 52-week highs. And you can see on this weekly chart that you've got this wonderful, unbroken, stepwise move up with the market continually producing these new 52-week highs. But there's a caveat in here, and it's a caveat we always mention. This is an index. It is not an individual stock. Part of the confusion that catches people is that they believe that because the index has gone up, their portfolio has gone up. That's not true. An index is an aggregation of stocks, and we'll see the impact of certain stocks in a moment. If I were to look at the number of S&P 500 stocks above a certain moving average of a certain length, I could probably guarantee you that 25% were below that moving average. And when we look at the local market, you'll actually see that a lot of our local market, despite our market hitting record highs, has done quite poorly. In terms of tradability, this is the thing we are concerned about. The end number at the end of the year is largely meaningless to us because we want to know about the trajectory, how things are occurring, so that when we look at the S&P 500, we can see there are three distinct trends that we could have traded as a daily trader. And we can now see that we've got this new breakout well beyond the 6,000 mark, which is also offering an opportunity to traders. Market began strongly at the beginning of the year, retraced a little bit, recovered and took off again. A little bit of a nasty blip around August, but once it broke through that support, off it went again. So we're at this point of looking at a market that has a decent endpoint return, but also offers tradability. This sits in contrast to our local market, which, whilst offering a positive return for the year, in terms of the ASX 200, it is not a variable tradable index if we're talking about the index. But there is a point to note about the US market that is important. This is a heat map. This is what's known as a quilt or a heat map. This is year-to-date performance of all the stocks in the S&P 500. You can see very green across the board. The thing to concentrate on are those I've highlighted in yellow, particularly this lower left-hand quadrant, which contains Apple, Nvidia, Microsoft, Google, Facebook. We've got Oracle and Netflix off to the right, Amazon in the middle, Tesla off to the extreme right. The US market offers opportunities that the local market does not, simply because of its size. And it is these stocks that have driven the US market along, particularly Nvidia. At the beginning of the year, everyone was talking about the Magnificent Seven. As we head towards the end of the year, people are only talking about Nvidia. So the concentration that existed at the beginning of the year has begun to whittle away to one stock driving the market. And we can see this here. This is the impact of Nvidia this year on the S&P 500. With the S&P 500, at the point this chart was generated, the S&P 500 was up 24.4%. If you remove Nvidia, it knocks 5% off that performance. So it is a significant contributor to the market. All well and good if you're involved in Nvidia, and there's some things to learn from looking at Nvidia and the potential to trade it. Not so good if you're in one of the other stocks. In terms of looking at Nvidia, it presents us with a wonderful picture. All I've added here is a simple breakout system. There's nothing complicated about this. One of the points I will make as we move through these slides is that you can make trading as hard as you want or as easy as you want. Generally, people who want to make it hard are doing so as a reflection of their ego. They want to prove to themselves that they are very clever and can do something that is difficult, and they want to prove to other people that they are very clever and can do something that is difficult. The green arrows you see here are a 20-week breakout. If you had bought simply on the 20-week breakout, you would have had a very successful year. If you brought on the 20-week breakout with a break from consolidation, you would have done extremely well. You would have come close to doubling your money at the beginning of the year. You would have come close to adding 50% of it in the middle of the year. And we've got this little endpoint pop. But there is a broader point in here that needs to be made. Quick pop quiz for the audience. Should you be shorting Nvidia this year? The correct answer is hell no. Anybody who said yes is a moron. Speaking of morons, this is a little post I took from Twitter. Someone somewhat giving a boast that they lost nearly $2 million shorting Nvidia this year and that they were still holding short positions. You can make it as hard as you want, or you can make it as difficult as you want. You can trade with the broad trend, or you can try and trade against it. Trading against it doesn't work. I mentioned the Russell index before. The Russell is the broad measure of the US market. People tend to concentrate on the Dow without realizing the Dow is simply 30 stocks. Those who are a bit more sensible concentrate on the S&P 500 because that is the aggregation of power stocks within the US. That is the bulk of the market's capitalization. But outside of that, there's a series of smaller tier indices, such as the Russell 2000. It gives an indication of the broad market strength of what we would make the mistake of calling them penny dreadfuls, but they're still somewhat expensive in many instances compared to our stocks. These are stocks that fall outside those indices, and it is often where a lot of the money trading US stocks is made, because these stocks have the capacity for outsized gains. When you look at a league table of the performance of US stocks for a year, the best performers come from this population. They don't come from the S&P 500. Yes, it does look impressive, Nvidia having that particular gain of the year, and Nvidia's impact upon the index looks impressive. But you have to understand how indexes are made. Nvidia's impact is a function of its market capitalization combined with its robust performance. It doesn't mean its performance is an outlier. Outlier performances come from these indices. But the important point here is to note this break at the 2450 mark. It is important for stock traders that these lower tier indices display strength. And the Russell 2000 has been doing so. When we look at a comparison between all US indices, you can see that. So if I were a US stock trader, my population that I would look at would be the Russell 2000. It would be in this lower tier of stocks. And this is the comparison I was speaking about. You can see that the S&P 500 has actually outperformed the NASDAQ 100. We have to be a little bit careful here, though, because these comparisons are time-based, and this is a year-to-date comparison. If I were to shift this comparison out a little bit, the performance of the NASDAQ would trounce the S&P 500. But what is interesting is the poor performance of the Dow year-to-date. It has been beaten by the Russell 2000. Again, to a degree, a function of fact, it's a very narrow index, very tiny at 30 stocks. So it's extremely idiosyncratic and not really representative of the broad market. In terms of local market, we sit here at 11.29%. There's an important little caveat here. This is year to date. If I was to shift that performance out to November, and so I looked at November to the end of November this year, that figure would be around about 19%, because the market had a pivot low in November last year. So again, we have to be a little bit careful about the decisions we make based upon these comparative performances. If I look at the ASX 200, the most important thing to note is the annotation I've made of a record high. It has been a very long time between drinks for the local market. And it is a very long time between drinks because there has been no commodity-based boom to give the market a lift. But as you'll see on this weekly chart, price has this lovely upward channel, and it's been channeling up all year. So it looks very clean, looks very clear. When I look at it on a daily chart, which is what I would look at initially as an index trader, not as an equities trader, there's not a lot of room to trade on this particular time frame on the ASX 200. I find the ASX 200 a very difficult index to trade. It is very problematic because it's quite noisy. It's quite noisy because it's quite illiquid, so there's not a lot of price discovery going on. And 26% of all stocks at the point of recording this in the ASX 200 have a negative return for the year. So again, we come back to that thing. Just because the index has gone up doesn't mean your stock has gone up. And a case in point, these are a selection of stocks I looked at their 1 year performance. You can see there's something quite familiar to these. There's a lot of resource stocks in here. There's a lot of legacy lithium stocks. What is intriguing is despite the appalling performance of these stocks, there will be people still going along this stock, just like our peanut before, who was trying to go short Nvidia. But in terms of things we can learn, what do we take from the performance of, let's call it a mid-tier ASX 200 stock? This is Zip, which has had a wonderful performance this year. Again, I've applied a very simple breakout system to it. There is nothing complex in this. There is no great coding. This occupies one line of code, no more than 20 characters. What we see here, Zip begins the year well, breaks out in February, congests, breaks out again in late July. The power in this is simply the capacity to wait for that particular breakout. And this is a pattern that repeats itself over and over again. It is this need to be patient. If you had been patient with Zip, even if you had caught the last breakout from, let's call it 140, you're now at 370. You've more than doubled your money simply by sitting and waiting for the congestion to end, not trying to guess when it would end, just waiting for it to end. We come back to this. You can make it as hard or as easy as you want. And that seems somewhat of a paradox because markets look very difficult. They look very hard to understand. They're full of noise. There's what's happening. There's all this information, all this news. You decide what you want to do with that. If you decide you want to make it easy, your trading looks like this, which is very relaxed, which to some degree, and it is odd to say, people don't want. People want to be busy, so they want their trading to be hard. If your trading is hard, that's a function of something you've done, something you want. It is not something the market is doing to you. If I break the local market down and look at what were the best performing sectors, we can see that information technology is the runaway winner. And when I look at the actual chart of technology, the information technology index, it looks very impressive. There's a little bit of a problem though. There's only 11 stocks in this index, according to S&P. So we're back to this problem again. Looks impressive, how do I trade it? We have to be careful because this is a small index, so we have to pay attention to what is within the index and what its components are doing. So what I've done here is picked the two best performers from within this very small index. What is intriguing about this and what is the excellent learning point about this is they look very similar. When you're trading an index that is doing very well, you want all the stocks to look similar. You don't want one runaway performer. Having a single runaway performer distorts what the index is telling you. So NXL and T&E look very similar. Begin the year congesting, break out May, April, congest again, take off, congest again, take off, both offering extraordinary returns. These are daily charts, so these are charts set for a trading perception. But if I look at NXL over a position, that is a position trader, someone who trades weekly, the same picture presents itself. Congestion, gap, congestion, gap. So again, with making 3 decisions in the year, you could have had a gain of 300-400% on this particular stock. You've only made 3 decisions. And those decisions are based upon drawing a straight line across price, marking where it fails, waiting for it to punch through that failure. So again, as hard as you want, it's easy as you want. In terms of commodities, there's 2 I want to look at because they represent slightly different trading opportunities. Everyone went all aflutter in their nether regions this year because gold actually went up for the first time in ages. But we can see it started the year strong, then congested for a quarter, then finished the year strong. So we've effectively got, on a daily chart, really only 2 tradable opportunities in here. And that is a problem for some commodities. Commodities are not unbounded like an equity. You can buy a stock like NXL at 50 cents and watch it go to $7. You don't see that with commodities because they actually have an economic underpinning into their usefulness. And you always have to be aware of this. This always has to factor into your trading of commodities. You do get some exceptional runaways. This is cocoa, which was one of the exceptional commodities, perhaps the exceptional commodity of the year. And I've taken the major tradable trend for cocoa, which occurred in the first quarter of this year, lasted for 91 days, 150% increase. And you think to yourself, well, that's not much, but the stocks can do 1,500%. This is a commodities contract, so it's geared. So you have excessive leverage within that. We had many members of our mentor program trade this. The best return that I saw was 165R. For those who are not familiar with the concept of R as a measure of return, think of it this way. R is risk. So if this trader risked $1,000 to trade this, their end profit was $165,000, 165R. This demonstrates the capacity of tradable commodities, those that trend well and do not have excess volatility, to produce these outsized gains, particularly when combined with very clever money management. Standard money management won't get you that return, but very clever money management will. I said I'd look at Bitcoin because no year is complete without looking at Bitcoin. Bitcoin is fascinating because it is an indication of people, A, trading their political view, B, trading their emotions. What people who trade Bitcoin are trying to do is, many of them believe that they are some sort of digital Che Guevara and they will bring down the entire old world order. Yeah, no, you won't. That's not going to happen. I'm agnostic regarding Bitcoin. I don't care about blockchain. My reading is it does none of the things people say it does. But that doesn't mean this is not a tradable instrument. And it is a tradable instrument. This is a daily chart. You can see it began the year strongly, then went nowhere up until the election, and then it's had this wonderful run. So the learning from this is that you trade what you see. You don't trade your opinion of what you see or your emotions of what you want to see. You trade what you see. Unfortunately, with Bitcoin, a lot of people were caught in that they didn't do that. They had spent too long on the internet watching videos about how the world's going to change instead of looking at it going, well, at present, it doesn't offer me an opportunity. I will come back when it does. And when it does offer me an opportunity, I will trade it. So the learning from this is your emotions need to be kept in check. What you think is an irrelevancy. What is relevant is what is actually happening. I did say I'd finish with a little bit of a Christmas present. And the little bit of the Christmas present is this. And it is news from the US that they are moving to 23-hour-a-day trading as of 2025. What this means for those of us in the world's most appalling time zone is that we'll be able to get direct access to US equities in a more, say, reasonable time frame, particularly as the European session opens for us, which is early evening. There will be a volume pop. There will be a great deal of interest in this. This does have flow-on effects outside of our ability to trade these markets with a great source of friction removed. It means that this little company here, ASX, which is the entity that oversees our markets, might face quite a bit of difficulty next year. Simply because if we remember back to the heat map I generated, why would you struggle to try and get small positions away in dodgy little mining stocks here in Australia when if you wait for 2 or 3 hours for the US market to open, you can trade any of the world's largest companies, but more importantly, get access to that population of Russell 2000 stocks that I spoke about earlier. Those stocks that give the greatest capacity for an outlier gain. So instead of being the victim of dodgy pump and dump schemes that run here locally in our smaller stocks, you can remove that source of friction and that problem instantly simply by opening the dealing system and dealing in US stocks. So from the perspective of the trader as a business, all of a sudden, this opens an entire new world and an entire new universe for us because it removes those days of having to get up at midnight or still be up at midnight and try and trade through that overnight session. All of a sudden, for those of us who want to trade the US markets on shorter term timeframes or who want to trade the vastly liquid US options market, we now have an opportunity. That door is now open. So I'm actually, from the business of trading as my business, I'm actually very bullish about 2025 and really quite excited about that. And I think the technical term for the ASX is they're probably sitting around having meetings at present going, we're stuffed.
I love that Christmas present, Chris. I think that is going to be so exciting for 2025. There are so many opportunities that will open up to us all as traders. So yes, exceptional. So if you could put into a nutshell, what would be the key learnings from this year?
We come back to the, and I do sound like a somewhat of an echo, somewhat of a broken record, simply because we always come back to the same principles. And to a degree, it is a little bit frustrating for me when I find people who, for some reason, just can't seem to grasp. Price will tell you everything you need to know. You just need to shut up and listen. But the problem is most people won't listen because everybody's got an opinion. I think it should do this. I think it'll do this. Bitcoin's going to change the world. No, it's not. Just trade the damn thing. Stop watching videos of 12-year-olds who still live at home with their mother and trade what you see. It's as simple as that. And again, I come back to this point. I harp on over and over again. You can make it hard if you want. Good luck with your projects. You can make it as easy as you want. And you can have a frictionless trading career. Doesn't mean you will always make money, but what it does mean is that your business and your interaction will be less emotionally taxing. If it is less emotionally taxing, then it also means that you are more efficient, you're more effective. Your decisions as a trader are better. If you're constantly chasing the market, I'll give you an example. I took advantage. I use, when we're on the road, I use TradingView, the US program. I recently took out their Black Friday subscription. So you got it at a mind-bogglingly discount. The thing that always intrigues me is that if you look at, because TradingView has a programming language, if you look at the number of scripts, that is the number of various bibbity-bobs that people have written, and they're generally indicators. Last time I counted, there was about 7,000. What for? Like, really? If you can't put up a chart, and I've mentioned this before, I've got a big red couch at the back of my room, which I stole off you.
You did. That used
I
to
don't
be
know
my
whether you've
couch.
noticed it's missing yet, but it's not there anymore. I have a big monitor, and that's not just me boasting. And I put the chart on the screen. I go back there, sit down, look at it. More green than red. It's more green. I'm going along. How many lines of code did that take?
So let's have a look
That's
at
the
the Australian market and how this ended up for the year as well, because I think from a macro perspective, Chris has added a lot of granularity to the way that we usually analyze these markets ourselves. So let's finish up with looking at the Australian market, and then we will tell you the next step in our talking trading journey. So I'm going to just quickly flick through, and a lot of you who are familiar with my work on how I do a market wrap will be familiar with how I analyze markets. So I've got all of these candlestick charts on a weekly chart, and I'm looking at the overall view to begin with the Australian market. The volatility is 1.96%, which means that the All Ords is going up and down by 1.96% per week, which means it's quite low in volatility. It's great. It means you're not likely to get stopped out irregularly and in a way that shocks you. So with lower volatility, in a lot of cases, it's sometimes a simpler trade. So we're above our moving average. The volatility is low, which means my macro is on, which means I can look for opportunities in the Australian market. But let's see where those opportunities could lie. Do they lie in the ASX 20? Currently, no, they do not. The ASX 20 is cold in relation to the rest of the market. Once we compare this XTL index to the All Ords, it is underperforming. So it is cold. And the way I do that is I look at the relative strength comparison, which you can see if you're watching on YouTube in the bottom part of the screen. And I can see that the RSC is underneath its own moving average, even though the ASX 20 is above its own moving average. What about the ASX 100? Currently, we are in limbo. It is not the shining star that people are making it out to be, and definitely the ASX 300 is not either. It is cold. It is roughly in line with the way the All Ords is trading, so it isn't an outperformer. Now, what does that lead us to as a conclusion? It means that the main opportunities are underneath the ASX 300. So just as Chris was saying with the US market, it's best not to look just at the top end of the market in terms of capitalization. To broaden out your perspective, I'm suggesting you do the same for the Australian market as well, because some of the high performers are not just the ones in the top layer of market capitalization. So yes, information technology was a hot performer all year. Even though there are only 11 stocks, there were many opportunities within those 11 to really capitalize on what you're seeing here. So the other thing to consider is energy was a cold sector, underneath its moving average for the whole year, underperforming the overall market. So if you had stocks in energy, and even if you do still now, have a careful look to see whether they belong in your portfolio and whether they should be playing with the other stocks there. Because if you're long while the rest of the energy market is going down, you have to wonder whether your little energy stock is also likely to go down or whether it has been already. So looking at the overall market can give you a clue where to place your money and where to lighten. Now, in limbo is the small industrials, and it has been all year. The small industrials has just been a lackluster performer, trying to outperform the market, never quite making it. A slight brief chance around about September to October, but that was it. So really small industrials, nothing to brag about, and in limbo currently. Whereas if we look at the NASDAQ, in relation to the All Ords, this is only at 3.51% volatility, which is low volatility for the NASDAQ, but it has been a stellar outperformer. We have got beautiful higher highs, higher lows, breaking past resistance with ease, and definitely with that resistance becoming support for future trading. So what we have here is something that could be translated into an index trade using ETFs. And that is something I suggest everybody investigate, and also to look at the S&P 500 at 2.49% volatility, quite low volatility. So it means you're not going to get thrown around the place, but it is hot, outperforming the Australian market all year. Very easy to read these chart patterns as well. If those of you who are listening who love candles, which I do, of course, I just think there's some beautiful breakout and retracement trades to be had here. If you're looking for an archetypal trade, that perfect trade, that marriage material trade that you really want to get involved with and see replicated into the future, looking at the S&P 500 is a great chart to use, particularly from around about 2022. The patterns have been very easy to understand and to see, and this also reveals that an index trade could be an option for the future. So I do think they are the main ones to consider. I think also the one to have a look at, though, in terms of an option trade is the FTSE 100. So this volatility has been dropping throughout the year. You can see that visually because the candles have become smaller and smaller. That very long candle that we had quite a few of those at the end of 2022. They've all dropped in size now and they're very small. But the interesting part about this is that there are range trading opportunities here. So if you're a call option writer, the FTSE is a fantastic index to consider. Sure, you'll get paid less right now because the volatility has come down, so you won't get paid quite as much for that position. But in terms of being able to use that position again and again and again, you have been given very few shocks this year with the FTSE, very readable and very easy to be able to interpret. So that is my market wrap up for the Australian market and how it compares to it's the UK with the FTSE and also the American market. But I'm hoping that what everybody in Talking Trading Land can see is that Chris and I are on your side. We are shoulder to shoulder with you. We are right next to you as you trade. We are doing the things that you are doing. We are making also the mistakes that we are making right now. Even though we have refined them over time, we are still looking to continually refine our processes. So it isn't something that this is a set and forget, that fixed mindset where you learned something when you were 20 and it's exactly the same as when you were 60. It just doesn't apply in the market. You have to be open-minded enough to continually take in new input and make minor modifications to your trading plan. So over the Christmas break, dig out your trading plan. Have a close look at it. Make sure that it is doing exactly what you need. Have you covered off every area? Is it so duplicatable that another trader could implement exactly the same format as your own trading? A lot of people decide around mid-December to mid-January to not enter any new positions, and that should be written into your trading plan. That is definitely a core strategy, how to handle your holidays. But also see what you can do with your objectives. What are your objectives telling you that you want trading to achieve for you? See if you can make those really cemented over the Christmas break. Working out, do you want to travel the world? Do you want to trade other markets? How many markets do you want to trade? Do you want to leave a legacy for yourself, your children, and your grandchildren? What is really important to you? What's the thing that gets your heart to beat just that little bit faster because you're so excited and passionate about what you can achieve? So now is the time. You are probably going to take time off over Christmas, even if it's just from Christmas to New Year's. And I want you to really think about where trading fits into your life. The traders that Chris, Tate and I have trained that have the best results are the ones that have the clearest view of their future. They know where they're heading and they know where they want to be. So now's the time. This is exactly the right time of year to plan what you want trading to provide for you, your lifestyle, and your family. Now, we do have a few summer series podcasts lined up for you, which I know you're going to love. There's one with me and Chris as well, and there's one with Bushy Martin. So stay tuned for those. But we actually are closing off the majority of our podcasts for the year. It'll be a bit irregular over the Christmas break, but we will be back again with the first show for 2025 on February 5th. So as you know, we have been doing this for quite a while, but it is still something that just brings us so much joy. And we love bringing these talking trading shows to you. The best way you can give us a big Christmas present is to tell your friends about talking trading. Good people know good people, but sometimes those people don't know how to get onto a podcast. So be sure to tell your friends. Make sure that you keep this community growing. It is thriving. We love dealing with our traders, and we love knowing that you are listening to every single episode. Now, Chris, any parting words for 2024?
Other than Merry Christmas? No.
A man of few words. All right. Well, enjoy your Christmas break. Happy trading. And I'm looking forward to continuing our journey together in 2025. Bye for now.
Bye.